So in the second part of this trading series, what we're going to go through is we're actually going to look at points of interest. Okay, it was going to be supply and demand standalone, but I'm changing it to be points of interest to encompass supply and demand as well. Now, first of all, let's just go into supply and demand. What is it? So supply, when supply is outstripping demand, prices will fall. Okay, it happens in everything in everyday life. Just think of the property market. It's generally quite easy to figure this out. When there are more houses than there are people, the value of houses will drop because people aren't willing to pay more price for something where there's an alternate somewhere else. Okay, you see it in the shops every day whenever you go grocery shopping. Same as with demand. When there is more demand than there is supply, prices increase. So can't remember the luxury brand, it might be Louis Vuitton, but one of them essentially with their handbags, which they do, the women's range, they will release a certain amount. So call it 2,000 of a particular brand a certain time of the year. They'll release only 2,000 of these things on a limited edition. Why? Because their customer base is millions and millions of people. So what can they do? They can increase the price. And they know that those are going to sell rapidly. So what happens? Uptick. Okay, so in order to identify supply and demand on the charts, it's really quite simple once you understand what a point of interest is. Okay, so point of interest, otherwise known as a POI, is exactly what it sounds like. It's a point of interest. It doesn't mean that you are going to get a trade away. It doesn't mean necessarily that you need to place an order straight out of it, but it's normally identified on a higher time frame using an opposite candle. Okay, so an opposite candle, what I mean by that is if the market is, let's say, dropping, an opposite candle would be a push-up candle and then continue with the drop. So you end up marking this area as a point of interest, okay? So I have blue candles going down, white candles going up. So blue, white, blue. What I'd be looking for is a retest of this area, which would be my point of interest to try to find a pattern which I know works extremely well to continue the market down, but I would try to look on a lower time frame once price reaches this area to confirm my point of interest. Now, this is great and all, and you've got the POI marked out, point of interest, but really the supply comes in the market, you can spot it by looking at imbalances, okay? So how does price react from these particular zones? Do we get imbalances on this retest? Do we get imbalances here? Did we get imbalances to begin with? Now, the way that I see imbalances is essentially, it could be big banks, could be institutions, could just be retail traders. But essentially, it's a huge momentum coming into the market. It could signify either a momentum shift or a continuation of momentum. Now, if you look at the average size of candles, you know, for this currency pair, pound US dollar, 4 hour, and we go up to this area, this is the close difference on between the open and the close. Okay, so if we just scan across 3 pips, 6 pips, 2 pips, 16.5, 10, 9, etc. And then sometimes you'll get a bit of a, you know, semi-monster, okay? So it's like 31 pips. Then this one here, 19 pips. We go up to the top here, which is part of the point of interest, it's 28, okay? So we're looking at an average of somewhere around about 10. You can also go by the overall range from the highs to the lows, okay? So, you know, you just need to count them and see what is the average. Say the average is 20, we're looking for candles which are around about 50 or 60. And the reason for that is we're just going to see huge imbalances being left behind. Now you can use an imbalance detector like what I do. I think, do I have it turned on? Yep, I've got this one just by Lux Algo. Really, really simple. So imbalance detector is just really helpful just to identify on the chart. The other one which I have as well is a inside bar detector because they're a little bit tougher to find. Now, for me, I'm not really interested when you see little small imbalances like that, okay? Little tiny imbalance, who cares about it? Like really, who cares? It's the larger imbalances. It's those ones which I'm really keen to see. I want to see huge imbalances like that happen because it gives me confidence to keep that momentum going in the chart and look for potentially a new pivot point which is being created. So, for example, if we're looking at price coming down from here, this was a previous POI. Price had worked its way down to here, pushed up, pressed down with a fair bit of aggression. Price pushed up again, came down, pushed up again, came down, pushed up a little bit, and then aggressively came down. Okay, so if we just look at the very basic structure of that, price is coming up and practically rebalancing every time, apart from right here, okay? So I know that there's a lot of trading strategies where people trade off of the imbalance I don't, okay? I don't trade off of the imbalance at all. I've got multiple reasons for that. I trade off what's classed as order blocks, people stuck in the wrong direction at the key areas on the chart, which is the points of interest, okay? So further up here, we're gonna go into that in the next video. For the time being, if you can identify where the supply and demand zones are, you effectively know what's gonna happen in the future. Price is technically or generally going to run these areas because there's a huge surge in concentration in that area. If you think of how a DOM chart works, effectively, I'm going to try to draw this out. Now, this is my very weak attempt of trying to create a DOM chart because in Forex, it's very difficult to get one which is accurate. But essentially, you have a current price and your broker is going to be charging you spreads around about these figures. So you've got your buy and your sell somewhere within this round figure. Now, if the market is going to shift upwards, effectively what's going to happen is that the broker is looking to buy at 101 in this case and trying to match it with somebody at 1, okay? Now, if there's a huge order coming into the market, let's just say as well, for example, that we have values next to these. Let's say that there's 1,000 of each one. So there's 1,000 at 101, there's 1,000 at 102, there's 1,000 at 103. Let's say that price is currently at 100, okay? So I come along into the market, let's just say that I'm HSBC Bank. I come in and say, I've got 4,000, which I want to be able to place into the market. What's going to happen? Price is going to jump to that because it's going to take the orders out of 101, 2, 3, and 4 to get that position into the trade. That's why you get the widening of spreads really quickly, and quite often you'll get it in those key points of interest. You'll also get it during spread hours. You'll get, and red news events, don't forget. So you'll get the widening of spreads because there's huge orders coming into the market. And generally speaking, there isn't enough liquidity. Again, we're going to go into that in the future. Not enough liquidity in the market just at those little tiny price points, which is why when you're looking at scalping, essentially when you're scalping on the 1 minute and you're looking at a stop loss of 1 or 2 pips, you've got to make sure that they're not in absolutely critical areas because you will just get spiked out. It happens regularly. So on a higher time frame, 15 minute, 1 hour, 4 hour, etc., you get to witness these things happening, but you also see the market shift with momentum. So after the spreads have done what they need to do and all of these orders have been purchased, the next round is essentially this. Next up is 105. Price is currently at 104, and then to the left of 104 is going to be 103, 102, 101, etc. So these are actually going to be over here now. But essentially, the broker is trying to match you up with whatever's next, just above you. And of course, there's decimals of these points too. But in the market, seeing supply and demand is when there's been a quick exchange within this DOM chart, okay? So with Forex, I'm just going to put this in as a caveat, we don't have access to the wider market, okay? So I use the charts of IC markets as a broker at the moment, and I'm just in talks with changing my actual broker, so I might switch from IC markets very shortly. Essentially, what you have access to is only that portion of the market, okay? So if you're using indicators like volume and you're using, you know, the sort of sideways volume, can't remember what it's called off the top of my head, but if you've got the charts on the side showing you the volume, you're only seeing the volume of whatever that broker's got access to. And if you're using something a little bit smaller, like Oanda, or if you're using something like Pepperstone, which doesn't have the wider market, you've only got their little fraction, not the bulk of it. So I tend not to use volume. I tend not to use those sorts of indicators because you generally get to see it in the charts themselves. Now over here, we can see there's a huge amount which is going into market over the 4 hour period, okay? So a huge candle came in. This area is a supply zone. There's tons of supply coming into the market. Further down here, this is supply, okay? Again, we got a little bit of supply which got refilled. Great, everything's balanced. It's a fair market around there. Again, what do we have? We have supply coming into the market, more supply, more supply. Fair enough, fair bit of demand coming in there, but it was refilling supply, okay? Price generally tends to come back to these areas, and when it does come to those areas, it's usually quite aggressive. So, you know, we get refills on those quite quickly. Again, what do we have at the moment? We've got demand coming into the market. We've got a nice strong push up. What's price likely going to do next? Well, it's probably going to continue to another area, but when it does come back down, I would expect that there's going to be a spike back down to a key area, a key point of interest. Okay, so on my charts, what I tend to do is I draw out the points of interest, To me, that is a point of interest. You have a push up, then you got it's an inside bar, but inside bar in there, and then a push up. To me, that's a key point of interest because price has been retested at that point. It's probably going to be retested again. The supply started coming into the market literally at the base of this wick over here. Okay, so we had to push up, push down, push up and rejection, tried to reject it again, and then push through. So supply comes in around here, or it's shown on the markets around there. But how is that relevant? Well, we mark out our points of interest based on those imbalances, okay? So again, point of interest to us coming back in the past is, the POI for me is going to be that final candle. POI further along, let's look over here, okay? The market's sort of consolidated. We've got a lot of retesting of this bottom down here. We've got pretty much equal lows, okay? So there's one sort of confluence for you. And then we could say, all right, where's the point of interest going to be? It's at the very least going to be that last push down, the overall push down from the wick of that blue candle, okay? That's where we had that shift in momentum and we had a nice break out of there, okay? We had a nice aggressive break. Has price come back to it yet? Almost. We've pretty much just rejected off of that initial zone. Where else going back, okay? So again, we've got a huge demand to push us through and break through the highs up here. We were then left behind a point of interest right at the very top. It's where price sort of pushed down, then pushed up, and then ended up closing a little bit lower. So we'll just look at that blue candle. Then we had the confirmation of supply coming back into the market with this imbalance, which wasn't retested. So again, that gives us an indication that once we've gone down, collected whatever we need to from further down, looks like it collected it from somewhere down here, the retest of that. When price came back up to it, because everyone else is aware of it, and this is where just a lot of, I believe bank orders how they actually work and how they scale in and scale out at their old positions. But essentially, once price came to it, it was only small, but we did get a little reaction off of it. Again, let's just try and find some more. We've got demand coming in there, tiny reaction off of that previous supply coming in, small reaction right off of there. Here we got demand coming into the market. What do? We retest that demand, try to push up. Let's try and find another point of interest in the market. We've got the imbalance being created right there. Let's get our point of interest on, drag it across, see if that was the retest. It wasn't. Further down, this is not necessarily a point of interest to me anymore. Why? Yes, it's got a couple of things which are good, like, sweeps of liquidity and stuff, but it's being rebalanced immediately, okay? The strength wasn't huge out of there. It was a huge push initially, but we've rebalanced it. Again, moving further down here, we've had an attempt at least halfway into that demand coming into the market, but the point of interest really, it only has to be loose, but it's going to be from that last push down, okay? So for me, it's there. Moving further back, what do we have? We have this huge supply coming into the market, point of interest, basically from the base of that to there, probably cover the top. Go across, did we get a move off of it? Tiny. How was that spotted? 2 huge moves. Okay, let's go back again. We've got even more. So these are generally quite simple, okay? That's a point of interest, but there's no imbalance, so maybe not mark that one on. But there perhaps, because we've had the retest from it. Did that get reaction? Let's see. Don't think so. Oh, we did. Small reaction again, but the market had shifted its momentum down here. Okay, so again, these points of interest, what I want you to do is go back on your charts and just start marking out these POIs. It's really quite simple. Again, just go through the last couple of years on the daily. You're only going to get, 700 candles. So just go through the last couple of years, jump up to the daily chart, use a naked chart, okay? Don't do bar replay, use a naked chart for this exercise. I want you to just spot them. They are really simple. We're just looking at the key zones. So key zone here, there. Just literally look at where the market's turning and see if you can make sense of this. Is there loads of imbalance? And then after you've done the daily, go through on the H4. Go through on the H4 and do perhaps the last year. And then go back on the M15 and again see how it works on the M15. And then save it into there. So group everything together, okay? So just grab everything, group it together and name it, okay? So this will be daily POI, okay? So you'll do all of those, hide it, move it away. Then once you've done the supply and demand zones, again, just go through, name it, daily SD, close it, hide it away. Keep those saved, okay? They will make sense. We're going to use them in the future. But essentially, at the end of this course, what you're going to be able to do is unleash all of those things and your chart will be complete. It will have all your trades on there. It will have all those key points of interest, supply and demand zones, order blocks, liquidity. You will start to see how it all works when you open it properly. Okay, so supply and demand, again, just recap really quickly. It's when there's institutional orders coming into the market. We're not that interested in like little just staggering moves like these sorts of things, okay? Yes, we had a nice push down, but you know, we're not that interested from things like that. We want to see momentum candles. We want to see momentum coming into the market. Why? That makes the point of interest above really strong. Again, when we're working our way down, really nice move. It makes this area very, very strong, okay? Because we're getting that shift. We need that big shift to switch the direction of the market. And that's when we go back to our Boston chart. It's why we use Boston chart, because we're having to break all these previous points of interest where there were the highs and the lows, signifying the last turn of the previous momentum. Relatively simple on this one, okay? Don't want to go into the major depths of supply and demand because you can go in for hours. Keep it simple. No need to overcomplicate it. Get stuck in. Any questions, stick them in the comments. And if you want to join me with how to trade, there's FTR, link below. If you just want to pick up on the markups, which I do daily, there's a link down there as well. Catch you in a bit.